Welcome to this explainer. We're going to completely demystify the intimidating world of property dispositions and tax accounting today. Let's get right into it. Picture this. You buy a $58,000 Tesla with Bitcoin. Did you just trigger a $14,800 tax bill? Yeah, you probably did, because the IRS, they treat Bitcoin as property. So a $40,000 gain on that crypto creates a massive unexpected tax hit. It really just goes to show that getting rid of any asset, whether it's machinery, real estate, or crypto, has some serious real-world consequences. So here's our roadmap for today. We're covering the basics of asset sales, how asset character defines the tax, the whole depreciation recapture trap, netting and look-back rules, and finally, deferring your tax bill. Section 1, the basics of asset sales. And to help us out, meet Esteban Delgado. We're going to follow the real-world tax journey of Esteban. He's the president of Teton Mountaineering, his business is growing, and he desperately needs to upgrade his machinery. But before signing anything, he has to start with the absolute foundational formula of property dispositions. Step 1, calculate the amount realized. Step 2, determine the adjusted basis. And Step 3, simply subtract the adjusted basis from the amount realized to compute your realized gain or loss. Sounds simple in theory, right? Well, the devil is absolutely in the details. Take your amount realized. That is not just cash. It's actually everything of value received from the buyer, less any selling costs. For instance, let's say Teton sells its old machinery for $230,000 in cash, plus $70,500 in marketable securities, minus a $500 broker fee. Their amount realized is exactly $300,000. It's the total economic value of the entire transaction. Section 2, asset character defines the tax. Basically, what kind of money is it? Okay, so now that Esteban knows he actually made money on the sale, he's got to determine the asset's character. There's a really clear distinction between ordinary, capital, and the magical Section 123(1) assets. Ordinary assets, think inventory or short-term business equipment, boom, hit with standard ordinary income rates. Investment or personal property, that gets capital gains treatment. But Section 123(1) assets, oh man, these are depreciable business assets and land held longer than a year. And they offer the best of both worlds. You get preferential capital gains treatment on net gains, but you still get ordinary deductions on net losses. It's a sweet deal. Section 3, the depreciation recapture trap. Or, as I like to call it, no double dipping. Now let's dive into arguably the trickiest part of the tax code. Congress hates double dipping. I mean, they really hate it. You can't take an ordinary deduction for depreciation while you own the asset to lower your taxes and then turn around and claim a preferential capital gain when you sell it. No way. Depreciation recapture forces you to change the character of a Section 1231 gain from that preferential capital gain back into ordinary income. And this happens up to the exact amount of the accumulated depreciation you previously claimed. So how does this actually impact the bottom line? Think about this number, $71,342. When Teton sells its machinery for a $71,342 gain, you might think, awesome, nice capital gain. But because they previously took over $380,000 in depreciation on that machinery, that entire $71,342 gain is recaptured. It is entirely taxed at the higher ordinary income rates. Recapture changes the character, not the amount of the gain. Section 4, netting and look-back rules. The logic tree. Once we characterize Esteban's individual gains and losses, he has to combine them through a highly specific netting process. If you trace the journey of a business asset sale, it perfectly illustrates how it works. You start from the realized gain at the very top, and then cascade down through holding periods, related party rules, and recapture. This flow is critical because it ensures you know exactly whether you're dealing with ordinary income or Section 1231 gains before you start combining anything. And that builds right into a strict three-step netting process. Step 1, you apply the depreciation recapture we were just talking about. Step 2, you net the remaining Section 1231 gains with any Section 1231 losses. If the losses win, it's treated as an ordinary loss, but if the gains win, you move to Step 3, finally applying the notorious look-back rule. See, the look-back rule exists because you can't just game the system by intentionally selling loss assets in year 1 and gain assets in year 2. The IRS is onto that. They make you look back a full 5 years. If you deducted any net Section 1231 losses as ordinary losses in that 5-year window, well, you have to recharacterize your current year gains back into ordinary income to offset them. Section 5, deferring your tax bill. the wherewithal to pay. Now, what if Esteban is merely trading real estate to expand and hasn't actually cashed out? Well, Congress provides a few lifelines for when you just lack the wherewithal to pay. First, Section 1031 like-kind exchanges allow you to defer gains when exchanging business or investment real estate for other real estate. Alternatively, involuntary conversions allow you to defer gains if your property is destroyed by something crazy, like a hurricane, a wildfire, or eminent domain, provided you reinvest the proceeds into a similar property. But, spoiler alert, this is definitely not an open-ended process. There is a strict, completely unforgiving timeline for a Starker deferred exchange. Esteban transfers his old property at day 0. From there, the clock is ticking. He has exactly 45 days to identify a new replacement warehouse and exactly 180 days to close the deal and receive the replacement property. Miss a single deadline and the whole deferral collapses into an immediate tax bill. Boom. He also has to keep in mind a few ironclad rules for this to work. First off, only real property qualifies, so no equipment, no delivery trucks. Second, both the old and new property must be used in a trade, business, or for investment. And third, if he receives any boot, which is non-like-kind property like cash or debt relief to even out the trade, that specific portion becomes instantly taxable as a recognized gain. Finally, let's say Esteban sells land and lets the buyer pay over time. In that case, he can use the installment method. The gross profit percentage here is absolutely crucial. It indicates the percentage of the contract price that will ultimately be recognized as gain. Basically, he can spread out his tax hit pro rata based on that percentage for each payment he receives, meaning he only pays tax as the cash actually hits his bank account. So as we leave Esteban to enjoy his newly expanded Teton Mountaineering, we really have to ask a final question. You've realized the gain. You've characterized the asset, but are you properly leveraging these tax deferral strategies for your own business assets? Because as we've just seen, disposing of property doesn't have to mean a punishing tax bill if you structure it right. Take a hard look at your own assets. Are you leaving tax savings on the table?